Come on. 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Monday, January 10th, 2022. And our top stories today: the Department of Labor clarifies its guidance on private equity in 401k plans, and pensions improved in 2021, but companies may abandon them faster in 22. Joining me now to discuss this and a lot more, Austin Ramsey is a journalist with Bloomberg Law. Austin, great to see you. Happy New Year. Thanks so much for joining us on the program this morning.
Happy New Year. Thanks for having me on.
Yeah, and we were joking before, I think it was The Who, same new boss, same as the old boss, and 22 looks like it's shaping up to be similar to 2021, at least initially. But prior to the end of 2021, we got some clarification from the Department of Labor around private equity and 401k plans. You cover this space as well as anybody. What can you tell us about this developing news?
Yeah, so this is the Biden administration essentially, coming in and doing something that's not quite regulatory, but what we often refer to as sub-regulatory guidance to fiduciaries and plan sponsors who are in charge of making investment decisions or offering investment what they call designated alternatives to participants in 401ks or 401k-like plans. So this supplemental statement that the DOL has issued essentially says that, unlike what the Trump administration said, which is that private equity investments will be treated just like any other type of investment in a 401k style plan, it might not be, according to the Biden administration, appropriate for small plans. In other words, private equity finicky part of the market, and it may not be the case that fiduciaries in small plans have the expertise or are able to hire on the expertise to be able to make decisions that would be in participants' best interest. At the end of the day, ERISA, the Employee Retirement Income Security Act, requires that fiduciaries in charge of these kinds of plans both make prudent decisions about investments and that they are making those investment decisions in participants' best interests. And often, mistakes can be made not because they are, a fiduciary is making a decision that is solely necessarily intended to be against a participant's best interest, but it can be accidentally against a participant's best interest. And when you're working with private equity investments that are not on your traditional stock exchange, those kinds of mistakes may be easier, especially in smaller plans.
So Austin, this really, to your point, kind of reverses or clarifies, I guess is the right word, the June 2020 information letter that, as you said, came out during the Trump administration. Have you received reaction or seen the reaction of members of the industry about this? Is this expected? What are people saying?
It is expected. We expected the Biden administration to do something that would reverse, what the Trump administration had said on private equity. On one side of that camp, that could have been in the form of rulemaking that that outright prohibited private equity, created private equity as a prohibited transaction within 401k style plans. Or on the other camp, not touch it at all. I think what the Biden administration has done here is kind of split the middle. They have found a way to say, look, we're not saying private equity isn't entirely allowed, but in your average small 401k that I think a lot of participants are in, it's probably not the best decision. They haven't prohibited it. They haven't said that small 401ks can't provide private equity investments as a designated alternative, but they have said that it may not be appropriate. And under that scrutiny, there might be more ire from the department in the form of investigations or in the form of audits should small 401ks choose to invest in this way. And you're right. I think this all kind of stems from that 2020 information letter that the Department of Labor issued, I believe, in June. And essentially, that was an information letter that was requested by stakeholders. So in other words, you had private equity firms that were going to the Department of Labor and saying, "Look, we're doing this. This is something that exists as a designated alternative in some 401k plans. We want to ensure that is within the constraints of ERISA. Is this allowed? Can we continue to do this?" And what the Trump administration, said was, yes, look, we're going to treat this like any other investment. We're going to make sure that you're being prudent and that you're acting in participants' best interest. And otherwise, move on ahead, full steam ahead. But we got an idea, even under the Trump administration, that this may not be the final word on this, because the SEC came out just a few months later and said, look, this might be something that we need to investigate, because we might be likely to see a lot of registered investment advisors working in the 401k space more than ever, who work with private equity firms. Private equity, as I've said, it's a thicky business. There is a lot of room for abuse. I'm not saying, abuse happens a lot, but there's room for abuse. And so I think a lot of these regulatory agencies were a little uncomfortable once the Trump administration had issued that first letter. We're now seeing the Biden administration, take one step further.
Yeah, it's going to be interesting to see. I know there's been a lot of talk about including these types of products in target date funds, managed accounts, other larger portfolio solutions. So it'll be interesting to see how this moves forward in 2022 and beyond. Austin, I need to take a very quick break. When we come back, we'll talk about how pensions improved in 2021, but that just may mean that companies abandon them quicker in 22. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Austin Ramsey of Bloomberg Law. Austin, thanks so much for staying with us this morning.
Absolutely. Thanks for having me.
And so we're going to shift from 401k plans where there isn't a lot of private equity or alternative investments. Now we're going to talk a little bit about pensions where there are alternative investments like private equity, hedge funds, etc. But we're not talking specifically about that. The pensions actually improved in 2021, which I think is a good thing, but that could speed things up in terms of abandoning pensions in 22. What can you tell us here?
Yeah, so in many ways, this was expected. The market performed pretty well in 21, contrary to what a lot of financial experts had predicted at the beginning of the year. I think that's for a number of reasons. I'm sure your show has covered it. Many have. At the end of the day, the industries that needed to stay in business stayed in business. The industries that didn't pivoted, and so we have seen on average about a 9% gain in defined benefit pension plans. And so what that means is that on average, these larger pension plans with Fortune 1000 companies are funded at about 96% now. That's the closest to 100% that we've seen since 2007. Of course, that was right before the 08-09 financial recession. And yeah, that, at face value, that seems like a great thing. And it is a good thing because that means that, at least according to regulators, these pension plans are prepared to make the payments to participants that they have promised, and, all is well. The problem is that we know that the pension industry has taken a downturn, and it's really taken a downturn since the 1970s, 1980s. Pensions have been slowly and in some cases quickly declining in popularity. We've seen just this pitch downward really since ERISA was passed. And so what that means is that employers, in some cases unions, are looking to get out of the pension business. And the way that they do that usually is by de-risking, and that means that they're absolving themselves of the risk and pivoting the risk or off-putting the risk to another entity, or in some cases to the participants themselves. Usually this happens in one of two ways. The first way is that they just buy participants out. You get a lump sum from your pension plan saying, look, we're buying you out, we're not going to continue to make investments on your behalf, but here's all of the money that you're owed. Or, and this is probably the more common that we see in especially large pensions, they're going to take out an annuity on you. They're going to go to an insurance company. They're going to purchase an annuity plan. And then that risk is going to be on the insurance company. And in many cases, insurance companies, they want to take on this risk because it means that they are, they're taking on a totally different asset class that they can hedge against the different assets that they already have invested in the marketplace. And so it's a good investment for them. By and large, we're not seeing a lot of insurance companies go under because they're taking on this risk. But it does mean that the employer or the union or the pension plan, the 401 or the 403B that's taken you on, they may no longer be in the business here. They are not the ones responsible for your pension. And so what's likely to happen here, and a lot of experts agree on this, is that now that it's cheaper to buy you out, or it's cheaper to purchase an annuity because they have more cash up front, they're probably going to be doing that. We saw a lot of de-risking occur in 21, and we're expecting to see a whole lot more in 2022.
So, and I think a lot of that has to do with market conditions, also interest rates. We're going to see interest rate hikes, several by all accounts, in 2022. If I'm a participant in these plans, and Austin, I work for one of these Fortune 1000, and again, I want to clarify, we're talking about corporate 401k, or excuse me, corporate pensions. We're not talking about government pensions, public sector pensions. But what do I need to be aware of? What would I receive to communicate that this could happen, and what do I need to do?
Well, the most important thing that you need to do is just be aware. what we see most often in terms of participant hurt when it comes to de-risking is that a participant just doesn't know. Look, they are required to make certain disclosures. Usually those disclosures are made by mail because a lot of these pension plans are dealing, let's be honest, with older participants. And so they have not taken on, the Department of Labor's, recommendations as of this point of making the majority of their disclosures online or using online disclosures in addition to mailing disclosures. And so usually you're going to get a piece of mail, and that's going to inform you either of the fact that you were going to be in receipt of a lump sum check from your pension, or that this new insurance company is going to be in charge of making payments and or making investments on your behalf. The reason that that's important is for missing participants. Look, a lot of participants may move from the company. They may not know that the pension that they were dealing with before, the pension board, the pension organization that they were dealing with before, the record keeper, they may not know that company is in any way, dealing with your pension at all, and so they may go to that record keeper 10 years from now, 15 years from now and say, I'm retired, where's my check? And the record keeper is going to say, look, we have no record of you. We don't deal with you. Look, we would hope that obviously they would inform you, but they're not required to. And so the most important thing I think for participants to know here is that they need to be keeping track. If you are in a defined benefit pension style plan, you are at more risk than any other participant of a lot of change, of ownership, if you will, in your plan. And so you just need to, maybe on an annual, on a biannual basis, check in, make sure that, the record keeper that you knew, is still dealing with your plan. And if not, you need to be in communication. You need to be in touch with the company, often an insurance provider, that may have the assets of your plan. By and large, we're not seeing a lot of abuse here. We're not seeing insurers going under. Obviously, they're not covered by the Pension Benefit Guaranty Corporation, but they are covered by state laws. And most states have very strict laws in place that require payments. They require participants to be made whole, even in the case of a foreclosure. And so we're not seeing a lot of abuse. But I think what's most important here is just ensuring that participants know who has their assets.
Austin, last question. I mean, is this the final nail in the coffin of the private sector pension plan? And my grandparents, your grandparents had pensions. And look, by all accounts, having that predictable income that you don't see in today's 401k, although we're getting there, I don't know, it's kind of disappointing to see these plans go away, although they still reside in the public sector, but in the private sector, they are going away. But is this the final nail in that coffin?
I ask that question of the experts that I talk to on at least a weekly basis. And usually the answer that I get is, look, we're closer than ever. We're certainly not going in a good direction. We're not going in a direction where we're expecting to see, new private sector pensions cropping up. The rate of new private sector pensions is close to zero, and it has been really since the 90s. But I will say you bring up a really good point, and that is what is most valued in private sector pension plans, or really defined benefit pension plans in general, is lifetime income. And more so than ever, we're seeing that Congress is really getting interested in providing lifetime income options in 401k or defined contribution style plans. And we're seeing employers reach out to record keepers and in some cases even insurers to ensure that those kinds of products are offered. The Secure Act, for the first time, allowed 401k style plans to provide kind of in-plan annuities. So essentially, you are starting to invest in an annuity style product while you're still contributing to your 401k. Usually the way that this was always done is that once you retire, you go to an insurance broker or an RIA, and you say, look, I want to ensure that the money that I have put into my 401k over a lifetime is going to last me until I die. How can I do that? And they're going to say, well, look, here is an AIG product. Here is a great bank product that is going to ensure that they're essentially going to hedge risk against you, and they are going to make sure that you are taken care of until you die. We're now seeing that participants can start making those kinds of determinations. They can start investing in those types of products while they're still working, and that, by and large, that's a good thing. There are a lot of complexities to that. Annuity products are expensive. Pensions are not. But we're seeing a slow and steady movement toward providing a lifetime income for participants. And I think that right there is the signal that answers your question. Because we're seeing this happen in the 401k and the defined contribution market, that means that pensions are just not providing the benefit that they provided before. There are not enough of them to ensure a secure retirement for enough of Americans. And so we've got to figure out an alternative here. That might be lifetime income products in plan. That might be something else. But I think the nail is in the coffin, and pensions are just on their way out.
Well, it sounds like this is going to be a story that we're going to be covering, and presumably you will be covering as well. Austin Ramsey, great to see you. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Thanks so much. Have a good one.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in lifestyle, wellness, finance, tech, so much more in all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives or check out our latest content? Then look at our website, and of course, check out our streaming partners, Amazon, Roku, Samsung, and over 100 more. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.